You are not underpaid. You are under-automated. Right now, somewhere in your city, someone earning your exact salary is quietly building a multi-million-dollar future. Same economy, same inflation, same rent, same grocery prices, but in 30 years your financial lives will not even look comparable. And the difference will not be intelligence, luck, crypto, or secret stock picks. It will be one automated decision made years earlier. Most people think wealth is built through income. It is not. Income determines lifestyle. Automation determines wealth. You can earn $60,000 a year and become financially independent. You can earn $200,000 and remain fragile. The gap is created quietly, monthly, almost invisibly. Two co-workers make $75,000. Same apartment cost, same tax bracket, same commute. 10 years later, one has hundreds of thousands invested. The other has upgraded furniture and a newer car. Neither feels irresponsible. But one built assets, while the other built expenses. Lifestyle compounds too, just in the opposite direction. Let's strip this down to math. If you invest $500 per month into a broad S&P 500 index fund and earn the long-term historical average return, over 40 years you may end up with over $3 million. You personally contributed around $240,000. The remaining millions came from time. The first decade feels slow. You might see 80 or 90,000 and feel unimpressed. That is the phase where most people stop. But around year 15 to 20, something changes. The account begins growing faster than your contributions. Around year 30, the growth becomes aggressive. At some point, your investments may earn more in a year than you do at your job. That is when the rules of life shift. Compound growth is quiet at the beginning and powerful at the end. Most people quit before the acceleration. Imagine someone who begins at 22 and automates $500 every month. No trading, no emotional reactions, no constant checking, just consistency. By 30, they see meaningful progress. By 40, they may approach 400,000. By 50, over $1 million. By 60, potentially several million depending on returns. They never looked wealthy in their 20s. They drove normal cars, they lived reasonably. But later they gain options. They can step back from stressful work. They can negotiate from strength. They can choose time over money. Nothing dramatic happened. They simply did not interrupt the system. Now imagine someone who earns the same amount, but waits. They say they will invest seriously once they earn more. Raises arrive and lifestyle expands with them. A nicer apartment, a newer vehicle, more frequent travel. Real investing begins at 35. Now to catch up, they must invest far more aggressively, sometimes triple the amount. Time is expensive when ignored. The longer you wait, the steeper the climb becomes. Compound interest is forgiving early and ruthless later. Here is a powerful illustration. One person invests $5,000 per year from age 25 to 35 and then stops completely. Total invested $50,000. Another waits until 35 and invests $5,000 every year until 65. Total invested $150,000. Despite investing 3 times as much money, the second person can retire with less because the first person gave their money more years to multiply. Compounding rewards duration more than effort. Starting early reduces the pressure later. The common fear is market crashes. Markets do crash, they always have. But historically, broad index markets have recovered over long time horizons. If you invest monthly, downturns become discounted buying opportunities. When prices fall 30%, your fixed contribution buys more shares. The people who build wealth are not those who avoid volatility, but those who survive it without breaking their system. Volatility feels dramatic in the moment. Over decades, it becomes noise. If this math is so straightforward, why do so many people struggle? Because your brain evolved for immediate survival, not long-term compounding. Present bias makes $500 today feel more real than millions decades from now. Loss aversion makes short-term losses feel catastrophic, even when long-term probability remains intact. Lifestyle inflation absorbs every raise unless you automate investing first. Without automation, discipline fades. Systems win where willpower fails. There is another hidden drag: fees. Even a 1% annual difference in cost can erode hundreds of thousands of dollars over decades. Same contributions, same market, different outcome. Wealth is built not only by what you earn, but by what you avoid leaking. Low-cost index funds exist for a reason. Minimizing friction allows compounding to do its job. Consider something uncomfortable. A large monthly car payment invested instead over decades can represent well over $1 million of potential growth. Most people unknowingly exchange long-term financial independence for short-term comfort and image. Spending is not the enemy. Unconscious spending is. Small monthly decisions, repeated consistently, shape decades. Look at retirement statistics, and you see the result of ignored automation. Many people approach retirement with balances that do not reflect decades of hard work, not because they lacked effort, but because small financial leaks compounded negatively. We research gadgets and vacations with intensity, but rarely spend equal time designing financial systems. The irony is that the system is simpler than most purchases. The blueprint is intentionally boring. Open a retirement account, choose a low-cost broad index fund. Automate contributions immediately after your paycheck arrives. Increase the percentage when income rises. Do not interrupt during market turbulence. Let time operate. Wealth rarely comes from dramatic insight. It comes from uninterrupted systems running quietly for decades. There are two versions of you several decades from now. One version has options, flexibility, and reduced stress about money. The other continues calculating expenses carefully and extending working years. Both versions are built gradually by decisions you make in the next 12 to 24 months. Time will amplify whichever direction you automate. Income is temporary. Systems are exponential. Starting early beats investing more later. Volatility is normal. Interrupting the process is costly. Fees matter. Consistency matters more. You do not need brilliance. You need repetition. Quiet monthly repetition. If you automated $500 starting this month and left it untouched for decades, the trajectory of your financial life would change in ways that are difficult to appreciate today. The real question is not whether the math works. It is whether you are willing to let time work for you instead of against you. And be honest with yourself. If you had to free up $500 per month starting now, what would you change first?